Good evening, guys. Ken at Tortoise Capital. This is the Foundation's Q&A check-in for February 8th, 2024. So the first thing I want to talk about is the Jonathan's question. His question was, I'd like to get a better understanding of trades on the open that I'm seeing you make in the daily report and that's like the hybrid swing. There's a bracket where I immediately place an R10 on each side of the opening, then take the first breakout. There's an OR3 where we wait for the 3 minute candle to close, then put in basically a bracket around that and take the first breakout from um, the opening range 3. And then a third one where, let's see, price moves higher than one risk box above the open, and we enter beyond the risk box while the candle is still forming. That's pretty close to the first one, which is sort of a deliberate bracket. Um, yeah. Your insight was, I think the bracket would be best for a candle where price is more under control and not making a huge move. OR3 and the third trade would both be for larger candles, but how do you decide which one to use? Well, um, I want to set it into context of sniper trading. I use this chart on maybe it was the small group, I think, um, and it seemed to resonate pretty well. In the sniper trading, we have we're planning to use setups. We're going to use any of these setups, and we plan to trade anything that meets one of these criteria and moves during the day during the execution phase. So when we run the sniper uh, criteria on let's call it a set of about 60 symbols, we have some large caps and we have some ETFs. And we have a few specials in there that aren't necessarily large caps, but which are favored trading vehicles, but roughly about 30 each. So we're going to run those setups against all of those and look for a number of symbols that are ready to go. You know, if it hits one of those patterns, then we think it's ready to go. So then that's gonna become our prepare list. And when we're doing the preparation on that, we're gonna do standard work. We're gonna compute our position size, the reward to risk ratio using the auto framer. We're going to stalk it, by which I mean um, if that's where the open is going to be, we're going to go back, 2, 10, and 30 days and take a look at all the turning points in the RL10. Let's say it just closed right here. We're going to say that candle is the day -1, and maybe this is day -30. So when I talk about stalking that, what I'm going to do is establish key price levels. So I'm going to be 5 cents above uh, the high of that day. I'm going to look at this one. I'm going to look at that one. Those are key reversal levels, and those become price targets. If it breaks through that line, then that's going to be significant. If it rejects that, so if it breaks through, if the reward to risk ratio is any good, to the next price level, I have to go back even further, then, I'm looking to make second entry. because I'm thinking I automatically want to be long if it breaks above yesterday's high. But I'm also looking for price. If it rejects, then I'm not allowed to be surprised because that's where it rejected over here. And look what happened after the rejection. It takes that shit seriously, you know. And by the same token, if it gets through to here and rolls over, I'm not allowed to be surprised because it did that here. And take a look at that reaction to rejection. But if it breaks out, then I'm willing to put that second position on, and then I got to go find the next um, resistance level to the upside. By the same token, I'm going to go 5 cents below yesterday's low. I'm going to mark these up. In the same logic, I'm looking to get short if I'm in the red zone. I'm not surprised if it does this. I'm not, if it breaks through here, I'm probably looking for a collapsing dragon or, yeah, that's exactly a collapsing dragon. And by the same token, if it reverses here, I'm not allowed to be surprised because it did that. Look at that affirmation, the power of affirmation. But if it breaks down, I'm looking to get my next position down. So I'm constructing this price ladder, and I'm treating the daily range from yesterday as the yellow zone. This is noise for swing trading. Until it breaks out of that yellow zone, I don't have any evidence that the tug of war between the buyers and sellers has changed at all from yesterday. Now, in this one, if this is the pure doji, then that's where it closed. Uh, the next thing I'm going to look for is I'm going to be thinking about gaps, range stats, fail stat, and the gain stat. These are things that I can do inside uh, uh, the night before inside my planning process because I know if the close was here, I know how big the gap has to be before it becomes a normal gap. So if that was the close, and if there's no gap, then I know that's a positive gap of 0. And then there is the gap stat to the upside, and then the gap stat to the downside. And these are normal sized gaps, and that predicts a normal sized follow through. But I know if it's above here, it's an abnormally large gap or an abnormally large gap in that direction. And both of those conditions create an expectation or an increased probability of a larger than normal follow through. So if this was where it closed and it gaps up, then the follow through to the close of the day is either going to be higher or lower. And if it gaps down, it's either going to finish higher or lower. So those are the 4 conditions. I just don't know which direction it's going to go because the statistics on follow through after the gap vary in as little as a week. Today it could be the last 30 times it gapped up, most of the time it followed through to the upside. Like 2/3 of the time it might go up, and 1/3 of the time it might go down. But a week from now, that could reverse. And so there's not an automatic way to play that based on the direction of the gap. But the magnitude of the gap matters because what we do know is that the bigger the gap, then the bigger the follow through. So all other things being equal, I want to know what the gap statistics are for the things that are on my prep list to know if that thing is in that range of abnormal. Because if it's abnormal, I have a greater than normal chance of getting a range stat move that day. So, all other things being equal, I'm going to prefer to trade on 3-minute bars fast anything that was a big gapper. So when I see the opening and I see all these negative gaps and I see all of these large gaps, then those two pools are the ones that are most likely to have the largest percentage move compared to normal. So that's what I want. So part of my preparation is to know how big the gap has to be for those things so that I can be alerted to which ones are the best. And I can prepare my trading platform by putting boxes of those sizes on there. Like I might just draw a box that had a midpoint on it, and I could drag it around. If I just plop that around on my chart, and I put that mark right where the close was, then as soon as the market opens, I can look to see where did it fall. Was it an abnormally large gap or negative gap, or was it inside the normal range, or was it a zero gap? So I'm going to want to trade those things as soon as I can because there was a lot of news apparently when the market was closed that has to get processed. Conversely, things that had zero gap, apparently there was nothing about the overnight news cycle that changed any of the underlying conditions. So there's nothing special to see there. And I can just wait for that to unfold on maybe on the 30-minute chart. But what I really want to do is pay attention to the ones that have large gaps. By the same token, I also know what the size of the range stat is. So in the same way that I did the gap, I can also draw two boxes that are the size of the range stat and drop that on the chart. And as soon as the market opens, I can put that those two things right on the opening price, and I know that for that one shining moment, the maximum reasonable move in either direction is that much. Now, why does that matter? Well, it matters because statistically, 2 times out of 5 in the large caps and commodities, um, the opening is within 10% of the high of the day or the low of the day. We just don't know which one. And then we also know that within 60 minutes or the first hour, 90% of the time, we have seen the high of the day or the low of the day. We just don't know which one it is. So that little piece of statistical fact is what gives us the slow frog strategy, which simply says wait an hour and see what price is doing and then get a read on it. So in the slow frog, I don't even trade in the first hour. I just wait till it gets an hour and then I look to see if price looked like this and is moving up, I can say, well, at 60 minutes in, that's the low of the day, and it's moving away from here. Now, this is either the price that's right here, let's say it's at the high of the day, that's either the high of the day or that's the low of the day 90% of the time, and it's moving that way. I'm willing to, in that little chart, in that price pattern, I'm willing to bet that's the low of the day. And now I can say, do I have an opportunity to trade this? Well, is there a pattern that I recognize? But the first thing I can say is if I put a range stat on that, I go to the low of the day and anchor the range stat, I can go up here and I can say, no matter what the pattern is there enough room from where the price is, not drawn to scale, to the top of the range stat? Is there enough room in here for me to have a 1R risk box and 2-to-1 reward boxes? Maybe this thing has moved so far up the stack that I've run out of maximum reasonable move, in which case I can't take that trade. But if there's at least a 2-to-1 remaining based on, let's call it the R10 and 2 risk boxes up to the range stat, and it's moving up, I can take that trade in the slow frog without any other pattern. I can just buy it because it's going, and there's enough room for a runaway move to work. Now, this whole idea of the opening range or the opening 2 times out of 5 being within 10% of the high or low of the day means that right from the opening, 2 times out of 5, you might see a thing that just goes, or it goes that way. And if you wait 60 minutes, there's a good chance that you missed all of the easy money and there's only a small amount left. So 2 times out of 5 is noticeable. So one of the things that we built in was not waiting 60 minutes for the slow frog, but going to 30 minutes. We don't have as much confidence as saying that, yep, that was going to be the low of the day and that's going to be the high of the day, but it gives you 30 minutes more to start catching that move if it looks like it's a runaway freight train, like Disney today. Big gap up, it was like a 10% gap, and then the rest of the day was another 4% move. It went more than a range stat. It went more than a range stat from the open, not even including the gap. So here's a case where Disney is a perfect example of a big gap predicts a big follow through. Even if you subtract out the gap 10%, that was still the biggest directional move of anything on my list all day. So 2 times out of 5, you'll be kicking. If you're waiting 60 minutes, 2 days out of 5, you're probably going to kick yourself and saying, man, why didn't I get on that thing sooner? That's just enough that all you remember are the times when it ran away from you, and you won't remember the times that it just mucked around. So the idea of adding the gap statistic in here is that if you know from the gap that you have an increased probability of one of these large moves, there's a good chance that a big gap up and a follow through, here's where it closed, a big gap up and then a follow through, that's more likely to be a directional move early because you got all of the news that makes people positive, and now all the buyers are coming in and getting on board. So in the first 2 or 3 hours, you might get all of that move like Disney, and then it peters out at some new price level. So when you combine the range stat and the gap stat, and then this little phenomenon of the 2 by 5, you start preferring to trade the ones that are big gap up or big gap down. Now, if it's a bear market, I want the big gap down even more If it's a bull market, I'll take either one of them. But a bear market, and it gaps down and is starting to sell up, dude, what more do you want? Uh, Now, one of the other things that we learned was that sometimes that move, instead of waiting 60 minutes, sometimes going at 30 minutes was better. And then we said, hey, what if we could go right from the opening? So that was our idea of the quick frog. And what the leapfrog, excuse me, the quick frog is this waiting 30 minutes and then going. Slow frog, wait 60 minutes, then go. Leapfrog simply says, whenever it opens, if I can just put some kind of modified frog box and bracket the opening, that as soon as I get a breakout, I can take that. I can go long because that looks like maybe that's going to be the one where uh, uh, it was the opening was going to be within the bottom 10% of the day, and um, maybe if I get this one, it's going to be the one that fades and drops like a stone. Well, when we first started doing this about 10 years ago, the size of this box was one full frog box. Historically, three R10s can equal one frog box. And so one of the things that we learned was if we had a big gap up and that thing just started taking right off, that waiting for a full frog box move was eating up half, sometimes even 2/3 of that first move right out the gate. So it was not unusual to see this thing open here and then just go, 1.5 to 2 frog boxes without any interruption at all. Well, what that meant was if we were waiting a full frog box, then we were only giving ourselves 1/2 to 1 frog box of follow-on gains. And because we were trailing that with a frog box, it was a crapshoot. It might go up a half and come back, and we'd lose half an R, and it felt very frustrating. So what we learned was that we wanted to see how much of the frog box we could whittle away and make this a smaller risk box so that we could get in sooner. One of the things that we did was we took a look at what if we just bracketed this with a full frog box and then took the mechanical entry and trailed it with the frog box and said, what was the exit? It turned out that uh, the winning trades, the average winning trade was about 0.6, which meant that it was moving 1.6 to the peak and then pulling back a full one, leaving us with only 0.6. So we said, well, that's stupid. We're giving back 2/3. So what we've ended up doing was we were able to whittle that down to about 0.3 of a frog box. So now, if we had a trade that looked like this, where we used to, from the open, give it a full frog box before we entered, with a stop at the open, and then that would be our stop and reverse. Well, what we learned was that we could actually make that entry, we could scale that thing down as low as 0.3, which meant that we were now entering at 0.3, which meant if you added 0.3 and 0.3 on, now what we were getting was an entry here and two, and if it went through here, we were holding +2 execution risk at a price level where it was positive expectancy to enter. And it was going to go another 0.6, which was two more of those 0.3. It would go almost 5, but then it would roll back, whatever. So this became the search for, you guessed it, the minimum manageable risk box. How small could we make that uh, that manageable risk box so that we could bracket the open on symbols that had very large gaps up or very large gaps down, and be ready to trade them right from the opening to try to get well started. So to review, as an example, everything that meets your criteria for wanting to trade intraday the next day, like all of the snipers, any mechanical swing, any pattern that hits that, like a 5-day down, a washout, a channeling, an overreaction, 551W, a triple screen, and anything that hits an auto framer with a great reward to risk ratio, any of those can also be used to be prepared to trade the next day, because it might be the first day of a directional swing trade that could last 3 to 5 days. All of these right here, we really just created those in order to get a good 1 day pop. And then if it followed through the next day, hey, that's even better. But we're really looking for 1 day pop. When you prepare a mechanical swing trade, you have a reason to believe that that signal and that move could last 3 to 5 days because of the historical performance of those patterns when they work. And the same thing with the auto framer. So whatever set of symbols you decide to prepare, docking includes understanding what all the statistics are for your symbols and having the chart prepared with all of those. And then the next morning, what you're looking for is maybe up to 4 symbols with the biggest gaps. And it depends on what your span of control is. I'd start with 1 or 2 and see what that's like and work on 3-minute charts. Now, all of the other ones, what we're waiting to see is if we are a sniper, is we're looking for the harsh winter. Because it's going to take evidence of a harsh winter, like right from the open, that thing has sold off an abnormal distance and now has just started to reverse. It's like a morning hook, if you will. How big does that have to be? 1.5 frog boxes. Is incontrovertibly a harsh winter. You can also go look at the MACD and see, is it in the winter? And so if we have a harsh winter, then the standard patterns for how to trade SSC, CD, and COTA2 on the 3-minute charts should be well known to you by this time. You might also see that, by the way, during the day on a 30-minute chart. Why? Well, because the previous day may have been a big sell-off that was enough to make the MACD histogram get in the winter, and then it opens and sells off 2 or 3 more bars, and then a couple hours in starts making that turn. You can look at that whole price structure and say, I've got an SSC because I'm using previous days patterns as part of my setup criteria. Check or hold on all that. So the harsh winter for anything that wasn't a big gapper, and I can probably use 30-minute charts on that one. So now what I want to do is talk about how these other means and modes of entry can also benefit us. Let's see. So 3-minute charts, if there's a big gap, the hybrid frog is nothing more than from the open, I can put I would say either like an R10 or an R5, depending on how comfortable you are with that. An R5 is twice the size of an R10. So an R10 means that there's 9 more of those boxes before it hits a range stat. An R5 means that there's 4 of those to the range stat move. So I have uh, plenty of evidence that that's not an unreasonable move. No matter where it opens, it can always move that far before it becomes crazy. And then similarly, I'm doing the same thing to the downside. 4, 5, 6, 7, 8, 9, 3, 4. So from the open, I'm ready to trade that one uh, simply as a hybrid frog, or in the language you're using, the bracket. I just choose the size of the bracket. Now, the OR3 idea is simply, let's say it was a small gap and it opens here, it sells off a little bit, moves up in here, comes back to here, and that's what my first 3 minutes looks like. So now what I'm going to do is, if I'm using the OR3, I can just put that box around the opening range 3, and then I can use that as my bracket. I can go like this, I can go like that, and then play the breakout. Now, what I want to know on that one is how big is the R10 compared to the OR3? If the R10 is like this, then that tells me there's very little volatility in here at all, that opening range 3 was really quiet. But if the opening range 3 was bigger than the R10, I actually like that, because now what I'm going to do is, in the next set of bars, whenever that is whenever that thing breaks out, I'm going to be long, and I'm going to probably use the R10. Now, there could be, if there was a PSAR flip involved in here, if this involved a PSAR flip, I got to bring that up and put it in here. And what I'm actually going to use for my execution stop is the PSAR, because what I really want is a price trigger, a price trigger pattern, if you will. That when the PSAR flips, that flips a switch, and that tells me, for example, that if I took this entry, then the price that tells me that this move is not happening is if price falls through the bottom of the PSAR when I hit a collapsing dragon. And as we said a number of weeks ago, if my R10 is inside here, I'm not going to trigger on the R10 because I'm in the noise. So what I instead am going to use is, I'm going to use the this as my -1 execution risk, the actual trigger, and then I'm going to ignore signals inside here. But if the PSAR box is smaller than the R10, if the R10 was something like that, then I'm going to position size off the R10. And then if I take this hit here, I'm still going to get out here because that's the technical price that told me the upside move isn't working. And I've already limited myself to about a -0.5 execution risk. So I like trading those little dojis because when they work, it's going to be great. But the R10 keeps me from getting too large of a position size. Because when this is a really tiny doji, even a little noise could kick me out of what could then turn around and be a great trade. So I don't want to have twice the position size because the doji was half the R10. You know what I mean? So I'm going to compare the technical signal that gets me out to the R10, and I'm going to take the wider of those two to be my one execution R. And then I'm just going to make sure that whatever the one execution R is, there's at least 2 units of reward available. Well, if you're using the SSC, remember what we said was the precondition of that was that it was a harsh winter, and that means it had to move 1.5 frog boxes from the open to the downside. And if 3 times an R10 equals the frog box, then 1.5 frog boxes equals 5 times the R10. This move is half a range stat, essentially. So if I had the open, so think about it this way, if I go half a range stat and half a range stat, half a range stat, and half a range stat, those are my 2 outer limits of the moves as measured from the open. And if this move of half a range stat constitutes a harsh winter, then if it turns around right here, there's my SSC pattern. And then if it fails, I still have 5 times the R10 for the collapsing dragon. So that's already pre-qualified as a good move. But if this was the low of the day after the harsh winter, then my move is going to be up half a range stat, half a range stat, and I think that move can now go to here. So that's some really good geometry. So when you're preparing your chart and you're going to put plus range stat and minus range stat on it, put the 50-yard line on there too. Is that making sense to you?
Yes.
Okay.
That's good.
All right. So, the final one that I want to talk about is the WMB3. Now, there's a lot of boxes in math, and one of the, just a minute, we got some feedback in here. All right, so this is one way that you can prepare your charts ahead of time. And to be honest, you could do that on the weekends because the amount of variation day to day in the range stat that week is going to be small enough that you could prepare that on Sunday night, and it's probably good enough for the rest of the week. You know, your mileage may vary, but you may find that good enough is good enough. Now, a simpler version of all this is to adopt the WMB3 strategy and just decide that, you know what, all I'm going to look at is if this was the close, I am only interested in the ones that have a negative gap because those are more likely driven by fear than the positive gaps. So I find the fear is much more reliable. So I like to concentrate on the big gaps down because I think that that is fear. Now, when I put that little bracket on it and it breaks below my R10, it only right from the open, it moves an R10 down. I'm already short. My favorite entry. Now, what I'm wondering is, how far is that thing going to go before it starts to reverse? So, if it drops half a range stat, I'm going to get something like 4 more of these little R10s, and now I'm at the half a range stat. The other thing I can do now is I can take a look at my fail stat. The fail stat goes back, I think it's 200 days, or maybe it's 30. I think it's 200 days. Maybe it's 30, but whichever one it is. That's the average loss from the open to the low of the day in that candle. So wherever it opened, and maybe this was the real body and that was the high and the low, all it does is measure from the open to the low of the day whenever that occurred. I don't know where in the day that occurred. I would like it to be right from the open. That would be awesome. The most likely time for that is going to be if there was a big gap down, which I treat as a giant red candle, and then it opens and then it fails. Now, if it fails the average distance of the fail stat and then gives me that little reversal, I'm not allowed to be surprised at that. And I know that the move up is still going to be a range stat. And now maybe I can get a 1, 2, 3 entry. And now what I have is a perfectly good entry, 2 or 3, 2 bars off the low of the day. And all I have to do when I make that entry is put my risk box just below the low of the day. And if that fails, treat it as a collapsing dragon. Because then I think, oh, whatever the size of the gap, here's evidence that it's continuing to fail. So I just treat that as a poor man's collapsing dragon, no matter what. The failure on a 1, 2, 3 entry is a collapsing dragon in the other direction. Are we clear on that?
But Ken, so these are ones that are big gaps down, or I guess it could be up as well.
Yeah. So
a big gap down, and it just
what I'm describing right here is only
okay.
what I'm describing right here is only the big gap down because
Okay.
that behaves differently than a big gap up.
Okay, I see what you're saying.
Because remember, the big gap, yeah, the big gap up is being driven by the eternal youthful optimists believe in the power of optimism and all that horse shit. But a big gap down, that is our pessimistic nature. That is the collapsing of everybody's dreams, and they are all failing right in front of us, and it's a goddamn disaster, and it's failing from the open. That is a different state of mind than a big gap up and go. I hate the gap up and go.
I'm sorry? You
I hate
hate the gap up and go.
what I hate is the big gap up and go. I hate it. What I love is a big gap up and fail. Right? So if this was the close and this is the open, I have a big gap up. I hate it when it's going up. As soon as it starts to fail, I love it. Because now I can take the high of the day and whatever my MMRB is, I've given it 1, and I can try that. If the rest of the day is down, like the S&P is down and the sectors are down, and this thing against all of the other, herd behavior gapped up and then is starting to fail, I believe that they caught the optimists, and now I'm going to get on board the fail train
So it sounds
because
like, I'm sorry, but
go
so it
ahead.
sounds like the bracket, this last trade you described and the bracket, they're both after big gaps down. The bracket is where it gaps down, but it gives you enough, it's not moving so hard. It gives you enough time to put your bracket on either side to see which way it's going to go. Whereas this last trade,
Yeah,
it's down and it just keeps going. And once it's gone, an
yeah, yeah. It's
MMRB,
already
then
on fire.
you're in.
Yeah,
As soon as that
yeah.
MM,
Now remember,
that's
so
an
if this
MMRB.
was the close. Yeah, if this was the close, let's just call it three conditions. What I want is either no gap or huge gap up or huge gap down, right? So it's beyond the threshold of the normal gap. So I either want like no gap, and now that is like a quiet bracket, and all this thing does is now it's making the breakout. Easy. That's rarely a runaway move. And why do I say that? Well, because there was no news. You know, news and surprise is what triggers the big gap up and the big gap down, and then people can't wait to react to it and adjust their position. But when there's no news, thing opens right where it closed. So now if I put my little breakout bracket, what do I have? I have a sideways quiet channel, and this thing started making a non-noise move away from the open. So maybe this is going to be one of those slow rollers that slowly accelerates, and I'm going to play that. But on the big gappers, up and a big gap down, I'm going to put I'm going to put the bracket on this one. What I want is this one. I want it to fail. I really want it to fail because now I can play the fade the gap, check or hold.
Got it.
What I hate is this one because what do? I buy it and I just say, God damn it, this is just going to fail. And as soon as it starts to fail, I'm out. And I'm going to trail that one with a MMRB anyway. And I know it's not going to work. So as it goes up, and then when it rolls over, I feel relief. But sometimes it actually works, but I never remember those. So I would much rather play the big gap down. And the one that I want to trade on that one is either one of them. Because if it's a big gap down and starts to recover, then I feel like, aha, they got him, and now off it's going to go. And then if it fails, it's like, oh, Katie bar the door. It's really going to fail. So in terms of priorities, I prefer 1, 2, 3, 4, 5. I would much rather play a sideways quiet channel, no gap with a quiet breakout than a gap and go. But it has to be like a zero gap, just and very orderly, within a couple pennies. Now, that's that's how I take that prepared list, base it on the gap, and I say, right, the biggest gap downs, that's the first place I like, especially if the S&P is down here, because then the whole market sucks. These big gappers up, okay, that might be some company specific news that's going up, but that's only the amount of money that's going into that is only the amount of money that's associated with one particular company. If the S&P gap down and my target gap down even more, then the whole market is on fire and failing. So that's the one I want. And I don't care if it's going down or reverses and goes back up. I would prefer that it's going down so I can be on that one, on the side of the devils. Now, when I get that harsh winter, let's say for whatever reason I couldn't get any gap trades or whatever, and it's not like, okay, the opening 30 minutes is over. Now what I'm looking for is all the ones that are harsh winter so that I can play this. Or even the WMB3 works like a poor man's SSC, because there I have the big harsh move down. It might have given me a 1, 2, 3 and enter, or I can just do the WMB3 strategy. Now, when there's a big gap down and then a quick sell off to the fail stat and starts to hold, it automatically starts the day oversold on Williams percent R. Then what I can do is I can just watch the 0 line in the MACD histogram, and as long as that thing is making new lows, nothing. As soon as that thing makes a higher low, now it hit an uptick on MACD histogram. Now I can go up to the candles and I can play the breakout from the previous high, and off I go. And that gets you in around an SSC, or sometimes even sooner than an SSC. So that ain't bad. The final thing that's not even on this list is, if you know what you see that thing has sold off and you got the low of the day, you can just automatically put anywhere from, call it an R10, an R5, or the frog box. You decide which one of those is your buffer. Because remember, the R10 is about 1/3 of a frog box. So you got like 1, 2, 3. And the R5 is twice the size of the R10, or you just wait for the frog box. Now, the frog rules always told us that from the low of the day, especially after a gap down, and you have the working low of the day, if it recovers and moves a full frog box off the low, that is the first non-noise move. And in the traditional slow frog rule set, a move of a frog box away from the last swing low, in this case the low of the day, was an entry. And then you trailed it with so I know that that's a safe entry. And what we've learned to do, because of the way we worked the opening, is we learned that we could manage even tighter stops. So in this idea, the simplest thing that you do is you just have a trailing buy stop that's one frog box off the bottom. That's not unlike the PSAR -1 flip. So if that thing is falling down in the harsh winter, then I can just go to the PSAR -1, and as it keeps making a new low, the new bar opens over here, and whenever that thing rockets off the bottom and hits my PSAR, I'm in. So either one of those is like a trailing buy stop technique. And I like, after a big gap, I like this one, because quite often the PSAR has too far to go to catch up. Like the big gap and then the sudden reversal, the PSAR is too far away because of the gap. But that little, like a 1, 2, 3 entry off a huge gap down, Why not? That's the lowest risk entry there was. You had 9 minutes for that thing to fail further and it didn't. How much more do you want? And you just put the wrist box on it, you hold your nose, and off you go. So this all of these strategies that I've been talking about really are geared on the big gap. And the best one is the big gap down. And if you've prepared 8 to 10 symbols on your prep list, just go to that one, and whichever was the biggest gap down, just treat that one as the most likely to be the surprise big move of the ones that you prepared. Check or hold.
That's great. Thank you.
So that's what I like to do with the big gap. And all of this standard work is everything that you can do the night before or on the weekend to prepare all that stuff. And if you know what your position size and your manageable risk box is and all that, you know what price you're going to get to no lose plus dinner for two on. And now you're going to rehearse this like with your 2 hour battle drill and your no lose plus dinner for two battle drill. So you've got all that stuff prepared. And then you trade the big gaps in the way I just described. Then after, here's the open, and then somewhere out around 30 minutes or 60 minutes, all the smoke has cleared, and now these things are starting to move and, making your move. You can go back in here and see, there was the low. There's the low of the day. Nice. There's the, maybe there's the high of the day. Awesome. Here was the dragon. Did some crap like, the dragon did this, and now I can start trading. Hey, I don't know, there's probably some find support, and there we go. And then if it breaks out, it's new evidence that it's leaving all this crap behind, and it's going to be that. Or if this ever fails, it's there, and then I can go find the VWAP. And if price is going up and it's north of the VWAP, I'm looking for those out of two kinds of patterns, right? And if it fails and comes down through the VWAP, I'm looking for collapsing dragons, that kind of stuff. So as the day progresses, I leave the chaos behind, and I still have 5.5 hours intraday to make my trades on maybe 30-minute on slow movers. And if it's starting to shape up as a reversal on the 30-minute, maybe that's where I drill down to the 3-minute to fine tune it. Or I'm just trading whatever came out of the smoke and was at the top of my stack or the bottom of the stack. Hey, where's the S&P? It's up here and it's going long. Well, I want to be in the winners. Oh, the S&P is here and it's going down. Oh, I want to trade the losers. And so you use that kind of strategy of relative strength to zero in on the things that are going. And then if you've only got uh, 8 symbols that you prepared, you should be able to put 8 thumbnails and watch them on 30-minute bars and see where the damn dragon is and what's going on, and then have the S&P over here, and maybe the VIX, so you can see volatility and then the broad market. And if you see the S&P bottom out and start to go, you're looking for the ones that are already going up, and you say, here we go. So you can use that to zero in on your use the market and volatility to zero in on your paired target, and then drill down and really focus on 1 or 2 symbols based on your span of control. But if it ain't on your prepared list, just leave it alone. Now, later in the day, during lunch or after lunch, this is where the absence of volatility is going to come from. So what I've got is, here's the open. and there was the big gap up, and this thing went up and up and up and up, and then it's rolling over and it's pulled back, and now it's gotten into this sideways quiet channel. And so the Bollinger Band mean kind of looked like this, and it's kind of, that's not unusual to see that. And the Z3 lines probably look like this, and now they compress. So once those things peak, this feels like the opening half of, 30 minutes or 60 minutes of chaos. And then you got the move of the day, and now that RL30 rolls over, and now you got the owl entry back. Now the target is back to wherever the Bollinger Band mean was. And if the VWAP, which I should have drawn that one in orange, then the most likely move is somewhere from that maximum excursion back to wherever the VWAP was, because that's probably where it's going to close during the day. And I don't know if this is going to go back in a hurry. The faster it gets back to here, the more likely it could go another length down. But if it slowly oozes back into here, then this is just, hey, they made their money and now they're just unleveraging their positions, and it ends up right here. Well, once all of this morning and early lunch smoke and chaos is over, somewhere in here, those Z3 lines have compressed to such a level that it's now smaller than a frog box. So if I've got I like drawing those outer lines in red, because now I can just treat that, the space between the Z3s is less than a frog box. That would be wonderful if that could also be, if that was an MMRB or two MMRBs or usually an R5. I can now take that as a Z3 pinch, and now I can play the breakout from here or the breakout from there. The advantage of this is that I can the high and maybe the low of the day was, and so now this breakout could go back to there. Maybe it only goes halfway, and maybe here it only goes halfway, but that's still worth taking because it might get back, test the high of the day, and then if it goes, then the size of this move is the size of that move. And if this gets to here and fails, I'd love that, because that's going to be like a collapsing dragon, but a new low of the day after lunch. That means that's a bunch of guys getting the hell out of that symbol before the close. That's the one I like. So I have to see the abnormally pinched SQC, and the definition of that is a Z3 pinch or a super pinch, which is a Z3 pinch plus all four regression lines inside that box. So now you have a tightly compressed box where the Z3 lines captured everything, and you have the R10, or RL10, the RL30, the RL90 is in there, and the RL270. All of that stuff is tightly compressed inside the super pinch, and that's like a little acorn. And that thing can really go. Rare to see that. When it happens, it's good. This is great, by the way. That's my favorite setup for uh, longer term swing trading. What I would love to see is something got murdered and then it has mucked around here long enough that the RL10 See, they all used to be up in here. All four regression lines were way up in there, and the RL10 was the first thing to leave, and it came down here. And then the RL9 or RL30 was the next one, and it came down here, and now it's joined. And then the RL90 was the next one. It was a little bit slower, but now it's joined. And then the RL270, the last one, is the slowest to recover. And then every little reversal here is trying to get back up to the RL270. But if it never does that and they all compress in here and the RL and the local Z3s are all compressed, now the breakout, this box is just like this box. And it goes from super pinch to super pinch, but how it gets there can vary. So that structure is how I need to see the abnormal Z3 pinch is good enough, super pinch is better. But by requiring intraday, the R10, RL10, and RL30 and the Z3 lines all to be less than a frog box in width, that requires that keeps you out of the chop, which is a problem. Okay. That's just about everything I want to say on all that. So prepare, find your tradables, and maybe it's also the mechanical swings, and maybe it's your usual suspects. Like I'm always going to do EWW, and then I prepare them, and then I look for the big gappers, preferably the big gap down, and then find the technique to get in. And then after the smoke clears, an hour or 30 minutes into that thing, after the smoke clears, start picking up those. And then if it's really working, it's kata twos. But if it's a big fail, then later in the day it's SSCs, collapsing dragon, kata twos. And then once everything settles down, then and only then am I looking for the breakout from range compression. Um,
Thanks, Ken. I think that was the entire course in an hour. I need to watch this again twice.
yeah, it is. Yeah, it kind of was.
So thank you.
But it takes more than one time to hear it, to be honest.
It does.
Now, I want to show, it just does. It just does. Hey, I watched a soccer game, so now I know how to play. Okay. Well, maybe not. Now, here's one I just want you to put on your back burner for long winter nights. Uh, this is our standard framing, and we turned off the price bars. And so all we're doing is we're looking at turning points in the R10 and when it crosses the baby dragon. And so you would be long here, and then somewhere in here you get short, and then you get long here, and then maybe long. If you got out here, you get long again, and then short, and then long, and then short and long and short, long and short, long, long again, short. And now, what is it getting ready to do? Alert. Do you think you could trade that, especially if the size of your wrist box was the width of the PSAR box? That's 6R, that's 4R, that's 5R. This is the Australian dollar, US dollar on 3-day bars. So each tick, if it did this, and you ended up getting that one. That would have been, 9 days of improvement with your stop there, risk, and off it goes. So this establishes a channel between 62 cents on the dollar and 71 cents on the dollar. So that's 0.62. That's 9 cents, which is about a 15% channel. And even if you did this, if this turns right here, we now have a out of two. So on the basis of that, I can tell you right now that I'm willing to buy right there. If this turns, I'm willing to buy 60. I'm ready to put that order in right now and just leave it alone with a stop right there. 0.648 to 0.658. So that's a penny. Aiming for three 3 cents, 3 to 1. And so each one of those that's 4, 5, 6, 7, 8, 9, 10, 11. That's 1 month. From here to here is about a month. So you don't need intraday data on that one. So for your long-term stuff, that ain't all bad. Here's a flashcard I want you to to think about. Let's say so this was an intraday. There's your OR3. So that's an OR3 entry. That's the R10. It failed below the Bollinger Band main, a 1, 2, 3 exit, so I'm out. It breaks out off, there's the PSAR flip. It moved a box off. The R10 reversed higher. It's front running the crossing of the Bollinger Band main, so I just re-entered the trade. Bam. Now, you should be able to name all these exits. This one is a R10 off the top. 2 is the R10 rolled over, so now I'm going to execute at the skin of the dragon. That's the dragon exit. 3 is a spine of the dragon, and it's a 1, 2, 3 exit. This is a 1, 2 exit. This is a 1, 2, 3 exit. This one is leaving the dragon. This one is the RLXD. And this one is, what the hell are you waiting for? I was waiting for a close below the PSAR. So that's what those are. And then if you notice, this was I guess it was right here. That's the first MACD histogram uptick. So you can get that. This would also be a MACD or a WMB3 entry because you had an oversold and oversold. And this is, you could actually get it right there when it gets higher than here. And then all of these are good. Here's where it peaks out. Look how good that is. This is the first decline in the MACD. So you should already be thinking about exits around in here. And that's why I like the PSAR during the rise. If I saw that, I might just say, you know what, I've already got this much favorable action in. Maybe I just prematurely go to the spine of the dragon or the skin of the dragon and then just take it. But certainly by the time the R10 rolls over, the RL10 rolls over, I want to be at the skin of the dragon. So how you get there might look like this. And maybe this one, after 1, 2, 3, and now starting to stall a little bit, maybe I'm just going to a 2-bar low and tracking it up. So you should be spending all your time figuring out how to manage those and manage that final exit. That's where 90% of your effort ought to be. Just hold your nose and get in. As long as you see bottoms and you know if that's my risk box and I've got 2 or 3 of those to the upside because it's early in the day, just go for it. Trust your gut. So disregard everything else I said. Just do whatever you feel. Kidding. Kidding, not kidding. I would take a screenshot of this one when you replay this. I would screenshot this one to give you ideas for your longer term meta system. And take a look at all the currencies on 3-day bars. Take a look at the big fat indexes on 3-day bars. You're really going to like that. You're really going to like that. You could craft a rule set just from that picture, and that's worth your effort. Tonight, I'm going to talk about this one on the 3-minute. This is Ethereum. You can only go long on Ethereum. So this is the open. It rolls over, finds support above the rising Bollinger Band mean. So now I'm happy to take the PSAR because I've got a COTA 2 risk to the bottom of the dragon. Up it goes at the oops, at the peak of the RL10 when it rolls over. Look, I got a couple dragon horns. I triggered it here, but I got filled right there. Summer turned to fall right here. It stayed fall until it turned to winter right here. There's your harsh winter. It carries into the spring and then reverses. So that's plenty of time to get out. So I can get out at the PSAR flip. There's spring, pulls back, exit at the Bollinger Band mean. So I get that trade. Re-enter here when it reverses out of the dragon. I go. Target the VWAP. It failed at the VWAP, started to fail. I'm out. I'm back in. Standard risk on all of those trades. Just like playing poker and just putting a chip in. And learning to read those slower moving indexes, like the middle of the river is the Bollinger Band mean. The dragon, the dragon is here. Very orderly. The VWAP is here. I'm going to probably turn that purple just so we don't confuse it with the dragon. And then finally, as we talked about last week, if you watch where the RL30 crosses the SMA 30, you should notice where the RL30 rolls over. Because this is the beginning of owl territory to the downside. Look how that gives you a directional bias. Those turning points in the RL30 are key. And now this is where the RL30 crossed the Bollinger Band mean. Here's where it crossed on the way down. So it turned here and it crossed the the SMA 30 there. And then it crossed the Bollinger Band mean here. So that gives you a really strong upward bias. This is a perfect entry now. So you can download this one from Patreon or take a screenshot when you rerun this. That RL30 crossing the SMA 30, which is the middle of the river, that's gold. Whether it's on 3-minute, 30-minute, daily, or 3-day. Okay, that's everything I got. We got the other one starting in about 5 minutes. We'll get this published and posted in the usual spot. Take good care. Keep those cards and letters coming.